As we all know from just basic behavioral finance characteristics that all of us humans have, there's different kinds of people with different drivers.
For us, that's the big definition there. We like to look at what we think of as structuring to create a diversified return stream. We like to see things that have low correlation.
That's Tony Minori, CIO of Empire Asset Management, and Bill DeRoche, CIO with AGF Investments. We'd like to thank Bill and AGF for sponsoring the live Think Tank Exchange and this podcast. I'm Dave Armstrong.
And I'm Dan Weiskopf. This is episode 203 of the Think Tank Exchange podcast. We're talking about why concentrating on correlation matters to investors. Thanks for joining. Mr. Armstrong, great having you co-host this podcast. As many of you know, my name is Dan Weiskopf, otherwise known as the ETF Professor, and I often speak about how structure matters in the way of ETF construction and security selection in a portfolio. Been a PM at Tarosa since 2018 and been focused on the industry as an ETF strategist for nearly 20 years. I spent a great deal of time with financial advisors hosting due diligence calls in the non-traditional category, which not coincidentally relates to what was spoken about in this episode.
Check.
Dave, you're a new voice to our podcast. Why don't you introduce yourself to the audience?
My pleasure, Dan, the ETF Professor. Thanks for introducing us.
Yep.
My background includes that of being an issuer and doing a lot of work in portfolio construction. So today's topics are very near and dear to my heart. Most of my focus has been around helping advisors understand what's available to their portfolios, why they may be helpful either from a risk or a return perspective. So now let's focus a little bit about how to use them.
Well, before going headlong into the correlation conversation, I'll remind our audience that our focus here at the ETF Think Tank Exchange is to provide thought leadership by bridging the gap between investment product specialists and the advisors who use their solutions through actionable ideas.
And in this podcast, we'll also add our own Tarosa take on the conversation. But first, let's let Bill DeRoche explain the role that alts play to lower correlation within a portfolio. Our own Dave Dziekanski sets things up.
Bill, how do you classify an investment as an alternative? And do you have categories of alternatives in your mind in terms of like breaking down the universe of available options? Like, how do you think about what is your opportunity set?
Yeah, we have a number of different categories that we use for our alternative investments. Typically we'll look at either what we would think of as either liquid or private. The liquid asset classes would be things that are publicly traded. From there, the two categories that we like to look at are alternative asset classes. Typically, you can think of them as, say, real estate, commodities. Those are gold even, would be examples of good alternative asset classes. And lastly, we like to look at what we think of as alternative strategies. Strategies typically would use structuring to create a diversified return stream. For those portfolios, there's typically a long and a short component. And by having that short component, you're going to end up with a strategy that has very low correlation to both core equity and core fixed income. For us, that's the big definition there. We like to see things that have low correlation to both core equity and core fixed income. And for us, that's what we would define as an alternative investment.
So Tony, Bill did a good job there explaining alternatives, as he would to an advisor. But as we all know, end clients may not understand, what an alternative is. How would you, when you think about alternatives, how would you describe it to your own end investors to kind of make it simple and make it clear that alternative doesn't necessarily mean that you won't participate on the upside. It just means that it's different.
That's actually, in my humble opinion, one of the great challenges in the advisor space, because as we all know from just basic behavioral finance characteristics that all of us humans have, there's different kinds of people with different drivers. And some people have a willingness to kind of go somewhat into the weeds. Other people want to find an advisor they trust, which is the essential foundation, but they really don't want to comprehend. They just understand the basic. You need to have diversification because you can't stomach the volatility of an all equity portfolio, and you work from there matching the financial plan. However, everyone, when you make the presentation at the start of a relationship, loves having a portfolio of low and non-correlating assets. Yet when they experience that portfolio, they become sad. First 3 quarters of 2018, S&P up 9%, the whole global index up 2%, and everything else was down. So you got an S&P up 9% setting records, and you have sadness because your commodities are down, your REITs aren't doing well, your multi-asset alternative is struggling. And so it is and ironically, our advisors who I build portfolios for, the first time they were actually getting it themselves was the fourth quarter of 18, when the S&P dropped 19.8%. Well, why was that? Because these other things weren't going down as much, or some of them, a couple, actually made a little bit of money. And people could finally experience it because in the 5+ years I've been at Empire, let's face it, it's been an S&P centric environment. You've largely, except under certain periods, been punished for any form of diversification, not just amongst assets, but within equities. And so you try, what we do at the beginning is to try to educate to the degree the client is open to it. And we need reinforcement along the way from the relationship manager to explain why things are doing what they're doing. And then you're getting involved with what Bill was talking about, portfolio structure. It's not just throwing a bunch of asset classes together, it's the structure.
You know, Armstrong, since I came from the hedge fund background, I often find myself struggling more with the definition of what is fixed income than what is alternatives. This kind of makes me a lone wolf. I mean, I was taught by depression babies that fixed income was a safety net. The money you parked in your mattress because you couldn't afford to lose that money, or money that you need to maintain a standard of living. However, today, fixed income is kind of upside down and really only yielding marginally more than the S&P 500. And I think this reflects the inherent risks that some investors don't appreciate. I might even argue with some that interest rates, where they are, make bonds their own alternative asset class. Put simply, when you net out inflation risks and you invest more of a portfolio in bonds with a long duration, you are only hoping to achieve a 2 to 3% annualized return or flat return after inflation. However, how is that really helpful? For me, that is why the alternative bucket is so important, and why at Tarosa we emphasize that people should have about 20% of a portfolio allocated to the non-traditional side of a portfolio. Non-correlated assets to equities and or fixed income are all about diversification, which is what every investor needs today. Risk mitigation is what the non-traditional bucket provides. But for advisors and PMs working with the traditional client, this thinking is very challenging. This is why I respect Tony's role so much.
Dan, I think you make a great point. And just to go back and build on something that Tony brought up, he talks about the idea that it's worth expanding. When advisors speak with investors about what they want to hear, basically getting into the weeds, as Tony had talked about, not all of them actually have the investment acumen to really understand what those investments are all about. Of course, alternatives can contribute to either lower volatility in a portfolio or improved return based upon the market environment that we have to be in. And that's why we talk about the idea of having proper diversification within the alt sleeve. That's what I think we're going to talk about next. Let's hear what the guys have to say.
Bill, if you could comment a little bit on what you're seeing in the factor world in terms of correlation amongst factors, correlation between factors in certain sectors. What have you seen in this kind of post-COVID environment on that side?
Yeah, I think one of the real highlights that we've seen is, obviously over this period, we've kind of almost gone through an entire mini cycle over, say, a 9-month period. If we go back to, say, the 08, 09 great financial crisis, it actually took over 5 months to actually reach the market bottom. For the market to recover, it took years and years. What we saw during this particular event was the market peaked in February and it bottomed in March, and then it quickly started to recover shortly thereafter. So events that normally would take months in terms of rotating during, say, business cycle events, rather than taking those months, they were taking weeks, if not days. So we were seeing factor rotations play out in a very short period of time. And as a result, those daily returns were of magnitudes that we had never seen before. So some of it had to do with the fact that, particular portfolios had become very crowded. And as a result, the factors were all in line with one another. So, for example, low volatility had been extremely popular. As a result, it had done exceptionally well. And because of that, the high momentum stocks, the stocks that had done exceptionally well, were all very much correlated with that low volatility. So as a result, when people became encouraged, when the vaccines were announced, there was a huge move out of those low volatility names, those high momentum names, and back into what we would describe as risk on. And over those few days where that occurred, we saw factor returns that we had never experienced. The only time we had come close to that would be back in the April 09 period. With that said, I think things are starting to, normalize somewhat. There are still some hurting going on in terms of folks that are very much skewed to either, reopening portfolios or stay at home. But with that said, I just don't expect to see what we have experienced over the last, say, 9 months going forward.
So, Tony, I want to go back to something you mentioned and hit on, which is this kind of correlation aspect of diversification. And listen, let's face it, everybody talks about diversification, but people only want non-correlated usually after the fact. When in reality, as we're managing other people's money, you have to fix the roof before it rains. I want to go back to this point about communicating. How do you communicate this idea that the best form of diversification is where things aren't all moving in lockstep? Because really for the last 9-10 months or so, we've seen this kind of unrelenting, highly correlated market where everything seems to be moving largely in the same way. But we all know that there's all kinds of concentration risk in that factor of kind of buy and hold and what we've seen here. So I'm curious, how do you kind of go through the correlation explanation process to your own investors?
Well, short of someone having a background in statistics, you don't want to go too deep into the weeds because you can actually intimidate people. What I start with and then see where it goes is a very basic example, because everyone understands the S&P 500, and you can just ballpark the historic volatility of the S&P is around 15. Okay, we're 100% S&P. Now we're going to take 5% and put them in U.S. REITs. And REITs are historic volatility at 22 or 23. We're going to be 95 S&P and 5% REITs. And I added a more volatile asset. But I've now lowered the full cycle volatility of the portfolio. And on the surface, that makes no sense. 95% 15 vol, 5% 23. That's not how it works. Okay, covariance, et cetera, and all those things. And when they start to get their head around that, you can then go into the other notion of other alternative asset classes. Bill mentioned a whole bunch of them. Okay, what I try to do is not just throw as many as I can in there. It's instead of putting together a 5 or 6 piece puzzle, though, I am putting together more than that. I already mentioned subsets within each asset class. You can manage volatility in the traditional asset classes, such as fixed income. Let's say you're my client, Michael, and I have you 30% fixed income. Well, for a while, I have you in emerging market debt. For whatever reason, I'm going to leave you at 30, but I sell the emerging market debt and put you in a short duration investment grade fund. Okay, I just changed the volatility makeup of the portfolio. Probably mitigated the expected return too in most scenarios. And that's the kind of way I educate in a broad sense. I literally talk about it and use a metaphor like a teeter-totter. All right.
I think
because when you're putting low correlation volatilities in or correlation, a lot of these asset classes have positive correlation to equities, but it's 0.6, it's 0.5, and so on. And so the great challenge, as we learned in 2009, is even though you think you're diversified, Bill talked about crisis situations. When the stuff hits the fan, correlations converge because people often need to raise liquidity and sell the good stuff. That's why we saw a temporary gold sell-off of great magnitude in the midst of March. The gold rally was interrupted, and then boy, did it pick up again. But that's the one where everyone tries to label a certain lower correlated asset, a diversifier, with some sort of concrete gold is for inflation. Okay, well then why did gold rally so much from 9/11 through the great financial crisis? We had disinflation. Okay, so it's not that. Well, gold is a currency. Okay, sometimes it is. It's a moving target, which is why you're constantly reevaluating the movement of correlations. If correlations were concrete, this would be the easiest job in the world.
Again, we'd like to thank AGF for sponsoring this Think Tank Exchange. Dan, this was a helpful segment. It reminds me that understanding market dynamics for an advisor and for their client is really all about stories. So often individuals are inclined to create a story that fits a single set of facts that they may be able to get their hands on. Tony's example of a teeter-totter really helps to expand the facts that an advisor or an investor might be considering relative to other market environments.
I loved his analogy on the teeter-totter. At the end of the day, it is all about up and down capture, and the smoother ride is just so important.
So, Bill, I want to bring you in here. So, at AGF, which again we appreciate for sponsoring Think Tank Exchange today. You guys focus on a lot of product creation and focus on alts, and one of the things that for me is always critical when thinking about correlation alternatives is up and down capture of a particular strategy. For those that are not familiar in the audience, if you wouldn't mind, maybe Bill, kind of explain what up and down capture really means and why it's so important to really look at that when constructing a portfolio, at least on the advisor side.
Yeah, as David mentioned earlier on, one of the primary condition for an alternative is that it has low correlation to core equity and core fixed income. That's necessary, but not sufficient. The other condition is that either it's return enhancing or it provides some hedging or insurance characteristics. When we look at things that are going to provide, say, hedging or insurance characteristics, obviously, when you go out and buy insurance, whether it's for your house or your car, there's going to be a cost associated with that. And eventually, hopefully, there'll be a payoff if you need the insurance. So when we look at things that can provide some hedging, say for left tail risk in the equity market, we want to make sure that the cost of that hedging is as low as possible, whereas the benefit associated with it, if markets sell off, are very high. So what we're looking for with regards to our investments is there's an asymmetry between the up capture ratio versus the down capture ratio. So, Michael, just as you alluded to, the up capture ratio looks at a strategy or an investment and basically says, how does it perform when markets go up? So typically, folks would look at it versus the S&P 500. To make their arithmetic easy, most folks would say use a 10% number. So if the S&P were up 10%, how much of the market would I capture? For insurance investments, the expectation is that's negative. That's not your normal investment. And it's negative because that's the cost of the insurance. We'd like to keep that as low as possible. Let's just say, for an example, the market goes up 10, the fund is down 5. That would be the cost of the insurance. But if we look on the other side, what's the down capture ratio? And let's say for the moment, the market is down 10%. We'd like to see the investment, say, be up 10%. So you're capturing 100% of the downside, but only giving up 50% of the upside. So you can do that. That's not a difficult thing to accomplish. And the reason for that is when markets go down, they tend to display quite a bit more volatility when they go up. We like to use the analogy that when the market goes up, it goes up like an escalator. When it drops, it goes down like an elevator. And when you look at investments that have significant leverage in them, whether that's financial leverage through more debt or operating leverage through more fixed operating costs, as well as more variability in the revenue stream, you can find companies that really will be punished when the market drops significantly. And that's one of the ways that we're able to capture that asymmetry in up capture versus down capture ratios.
Yeah, and I think asymmetry is probably quite difficult to try to discuss with an end client. And my favorite way to kind of show it to them has always been mixing a time period of great growth in an equity market with a negatively correlated vehicle that might actually have lost returns over a specific time period, and showing how that negative correlation could actually still boost your overall return. And sometimes they think it's magic. But if you could comment on vehicles like, and there was actually a study shown on Bitcoin from 18,000 to 5,000 on the way down, not on the way up, that rebalance in your portfolio during that period was so negatively correlated to equities, it actually juiced up your returns. So everyone's always looking for these high flyers, but it's really that structural negative correlation. Bill, if you could comment on that.
Yeah, so David, that's a really important point, and Tony's alluded to it some also, in that at the end of the day, we all want more cumulative wealth. It's very easy for everyone to understand that if I have higher returns, I'm going to have more cumulative wealth. But one of the other elements that goes into that calculation is volatility. Now, if I were to take two return streams that have the same annual return over a period, and one has more volatility than the other, the investment with the lower volatility is going to end up with more cumulative wealth. Just think of the example where if the market is down 50%, it needs to be up 100% to recoup your losses. So it's important for investors to recognize that if you can reduce volatility, and obviously if you're adding a negatively correlated asset to the portfolio, an insurance type product, you're really going to juice up that diversification, and you're going to really reduce the volatility. So there's a great way for you to capture that. And the example you just gave with Bitcoin is an excellent one. There's quite a few others that we could look at. I know when we talk about alternatives, sometimes what we're really discussing is within equity diversification. Those within equity diversification, such as REITs, which they have, say, a 0.7, 0.6 type correlation, are going to provide some diversification. But what we're talking about now with the negatives is significant. We're talking about hedging. We're talking about insurance type products, which are very different.
Dan, I love that segment because it gets back to something that you and I think about a lot, and that is the mathematics of returns. I loved it when Bill brought up the fact that he's actually thinking about that idea as well, that when you lose more money at some rate, you have to have an even higher rate of return to get yourself back to break even. So the role of alts is to try to find a way to smooth the investment experience for the investors, in many ways to try to help them stay invested for the long term.
It's just basically math, right? You need a lot more return to make up the loss when it goes down harder.
Yeah.
What's the math, Armstrong? Is it $1.50 to 1.5% to make up 1% loss or 2% loss? Do you remember that formula?
So the classic example is that a 50% loss has to be matched with a 100% return in order to get back to break even.
And as a result, they achieve a better return on a long-term basis because they're not going to lose as much money. I think that's pretty important.
Absolutely. That's thinking about the investor and the advisor.
So in each of these shows, we'd like to bring an advisor with his favorite charity to speak about. Tony brings up the Haitian Project, which is the one he really believes in.
So Tony, I know you had a charity that you're involved with. Maybe tell the audience a little bit about the charity and the good work you do.
Sure. There's a group called the Haitian Project. It was founded by some folks in the Providence, Rhode Island area, I think around 1990 or 92. And the goal of the organization, everyone knows Haiti is in an awful situation for decades and decades. And then a lot of people focused on it when that awful earthquake happened, about 12, 13, 14 years ago, whenever it was. And what often happens when there's a natural disaster is the world steps up and everyone helps. And then after the crisis is over and the people are out of the Doctors Without Borders type hospitals, everybody leaves. And this has been going on in Haiti for decades. And the founders know that the long-term solution to poverty should be centered around education. And education down in Haiti is a mess. So what this school does, and for those of us who grew up in the Northeast or the New England area, when I say it's a boarding school, this is not Andover, Exeter, and Deerfield, okay? This is a place where these kids, half of them barefoot, come and they do stay Monday through Friday, and they're fed, and they go to school, grades 7 through 12. To feed and house them, it only costs $1,500 per student. All right. But additionally, when they graduate, the project pays for them to go to Haitian universities. And as I was telling the panelists and the ETF think tank folks before we started, was Haiti has a per capita income around $800 with a 75% unemployment rate. A graduate gets a job around $15,000. Okay, that is life-changing. And unlike the many, many wonderful organizations that find somebody in countries like that and an amazing young woman, and they bring her to the States and she goes to Harvard and then she goes to medical school and she's a doctor in Los Angeles. Those are great stories. But other than her sending some money back to her family, it hasn't done a damn thing to turn the tide in Haiti. But these kids, 90% of the graduates go on and complete degrees and stay in Haiti. And this is a long slog. It's going to go on for decades more, but education is the key. So that's an organization I've been working with for some time, and my wife and I are dedicated to them. They're fine folks, and I went and spent some time down there because there's also a lot of fraud. Let's face it, there's a ton of fraud in, you send money down to some place that's in a country like that, and it's not a true charity. This place is amazing. It's legit. You've got people from multiple countries on the faculty, and these kids speak 3 languages. They speak Creole, they speak French, they speak English. They sang to an old man like me, and I before I left, and I had tears in my eyes. There's a million organizations to give to. Okay, they're in our hemisphere. We need to help. And I think it's a great charity. So thanks for anyone who's going to contribute.
Well, as we wrap up this episode, we'd like to thank AGF for sponsoring this podcast and the live show. You can learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for the ETF ideas, thought leadership, and strategies, tools, and growth tactics.
That's because our value proposition is to enhance yours. I'm Dave Armstrong.
And I'm Dan Weiskopf. Keep the exchange going with your clients. Until next time, take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.